If you're new to investing, or maybe you're an experienced investor in your local market looking to expand and diversify your portfolio into exciting US stocks, today's video is for you. Today we'll be covering US stock researching using my free watchlist template linked in the description below, which includes companies such as Apple, Netflix, Tesla, and JPMorgan Chase, to get some insights into which are the undervalued and high growth companies that are healthy that we might want to invest in. So if you're an active investor or a passive investor, or don't even know what that means, today we'll explain it all. If you're new to this channel, drop a like, smash that subscribe button, and help the channel grow. How to research US stocks. Here we have open my free US stock watchlist template, linked in the description below. And we'll start by looking at the different attributes in which we're going to compare and analyze these different stocks. So we can see the company names: Apple, Bank of America, General Motors, Netflix, Tesla down the side, and soon we'll fill in JPMorgan Chase. But to start with, here we look at, once we have the company name, the ticker code, current market price, the valuation. And the valuation here, in future videos, we'll look at how do we think about qualitative versus quantitative analysis? How do we look at things like DCF, or discounted cash flow modeling? But here we're just using the current valuation from an aggregate of analysts using a website, Simply Wall Street, and linked in the description below. Then we're looking at the value ratio, which compares the current valuation compared to the market price. And so here we can see Apple is 6% undervalued based on this valuation of $300.97. We're going to then look at the future growth. Here, Apple has an 8.9% future growth. The debt to equity. So here we want to make sure, what's the financial health of the company? Do they have a large amount of assets and liabilities? And both in the short term and the long term. Then we're going to look at what is the dividend that they pay out per annum. And then the dividend yield based on the market price. What's the return per year? What sector are they in? And then what industry? And then finally, we can have a column for the target buy price and the number of units we wish to attain. Now we'll enter the ticker code JPM to look at JPMorgan Chase. So we hit enter, and it automatically generates us the company name and the current market price. So now we need to add in a valuation. And we can do this based on a number of different valuation methods. But here I'm simply going to use Simply Wall Street, linked in the description below. And so on this website here, we can look at JP Morgan. And under the sidebar here, the third is valuation. And this uses an aggregate or an average of a number of analysts to produce a valuation for JP Morgan. And we can see currently the current price versus the fair value, which is the valuation. We can see that the analysts have valued it at $93.80. So we'll add that to our watch list. Here we enter $93.80, enter. And we can see now that JP Morgan is 1% overvalued based on this valuation. Let's look at the future growth now. So to see the future growth, we click number 4, future growth, on Simply Wall Street. And here we're able to look at the forecasted annual earnings growth of 24.8%. So we'll enter that in, 24.8%. And we can see that's a significant future growth. Next, we want to look at the financial health and gather the debt to equity ratio. So jumping back into Simply Wall Street, we'll look at the financial health. And here we can have a number of attributes we can look into and drill down. We can look at the short-term and long-term assets to liabilities. But really we just want to scroll straight down and look at the current debt to equity ratio, which is 256.1%. So let's enter that in. 256.1. And so now we've finished adding all of our attributes for JP Morgan. We've automatically generated the dividend yield of $3.6 per annum, which works out at 4.12% based on the current price. We know they're a financial services sector, and specifically in the bank's diversified industry. And so we could here write our target price and how many units we wish to purchase. Before jumping in to analyze a specific stock, let's talk about active versus passive trading. So active investing is looking at the short to medium term and a lot more quantity of trading or buying and selling by the investor. And so this is looking at buy low, sell high to actually beat the market returns. So on the other hand, we can look at passive investing. Passive investing often is less time consuming as we don't need to do as much research and analysis techniques because we use different asset types often, such as exchange trade funds. Here we can see this bottom line here is a Vanguard ETF, VOO, actually tracks the S&P 500 and has an average annualized return of 9.5%. Irrespective of if we want to be an active investor or a passive investor and using a diversified ETF portfolio, we need a brokerage or trading platform. And some of the very easy to use US platforms include Robinhood or Webull. And here in Australia and New Zealand, I like to use a platform called Stake, which I'll link a referral in the description below. And so currently we have an offer by Stake that if you use the link to sign up, you get one free stock once you fund your account with $10 US, and that free stock can be GoPro, Nike, or Dropbox. I think it's pretty good because Nike is currently trading at around $90 US per stock. So now we'll have a look at a single stock analysis. Great for an active investor. So General Motors Company, or ticker code GM, its market price is $22.48, and its valuation on Simply Wall Street is $57.37, which is 61% undervalued. That's quite massive. Next, we want to look at the future growth, 8%. So that's looking at the next 1 to 3 years, growing 8%. That's significant. Next, we look at the debt to equity ratio, and we've got over 200% debt to equity. So we really want to understand, is this large or appropriate for the industry? Next, we look at the dividend, which is actually 7.28%, considered quite a good return per annum. And we know that this company is an auto manufacturer. So I'm just a guy on the internet providing my opinion, and this is not financial advice. So you can look into these stocks further yourself and add in new stocks into this calculator and see what you can find. Now, if I were a passive investor, I'm going to now look at VOO. And what do I want to understand when I'm a passive investor? It's quite different. So here we're actually going to go onto the Vanguard website and have a look at VOO. And there's two key aspects we want to look at when we're thinking about an ETF asset class. We want to look at the expense ratio, which is really the management fees as a proportion of the principal investment. And so here we can see that 0.03% is a very low expense ratio. And here they've done a comparison against an average. But also we want to think, what is the return of investment? Do we average this over the long period, which we're going to say 10 years. And so here we can see that VOO is a 9% average return over a 10-year period, which is quite a good return for an ETF. I hope you learn a lot about active and passive investing, and I hope you can leverage this free template that I've shared in the description below to create your portfolio and start to create your own wealth. Thanks guys, see you next time.